Well, hello everyone. Welcome to Trading a Smaller Account. It is another fresh new week in the markets, and we are going to have a look at our accounts today. Our focus today will be on vertical trades. So we're going to look at both some bearish opportunities and some bullish opportunities. We're going to do a little bit of trade management. In other words, it's a regular day here in our Trading a Smaller Account world. I want to thank all of the usual suspects who are here at each and every other class. I saw Riceberg tuning in, and Will, and I Never Eat here, and Bill and Jack and Sharon and David and the rest of the gang. So it's great to see so many familiar faces. Rocky Raccoon and Paul started us off, so kudos to those two for being the first into the chat. If you are joining us for the first time, feel free to type a greeting into the chat so that we can welcome you. We link arms here together every Monday and Friday and talk trading a smaller account. Also, outside of that, a way for me to communicate with you and you with me is through the land of X, formerly known as Twitter. Consider this your invitation to join me on X, my handle, Barb Armstrong CS. We also have, as someone said in the chat, the Ben Watson with us today, riding shotgun in the chat, and you'll want to follow him as well. He's posting lots of great content at Ben Watson CS. So just as we get into things, know that options carry a high level of risk and aren't suitable for all investors. You have to meet certain requirements in order to trade options through Schwab, and not all will qualify. We want to take transaction costs into account. We use the Paper Money software application on the Thinkorswim desktop platform. It's a brilliant place to learn and make sure you understand how the platform works, and make sure you understand a trading strategy by practicing it multiple times in Paper Money before you consider trading it in a live account. There are some nuances and differences. One is that short options will never be assigned early in Paper Money, and that can happen in a live account. And recently we discussed kind of in great detail, how and when that might happen. So we're going to do a very quick market overview. I also want to show you where you can access a couple of other resources. This Saturday, Ben and I will be in New York City, in the heart of the theater district. We'll be at the Marriott Marquis. I know that Sharon is going to join us there, and I have a feeling that there will be many others as well. Well, hundreds and hundreds of people come into these events. And if you have never been and you're going, hey, what is she talking about here? Let me just bring you over. Whoops. Sorry, let me bring Google back up. I just messed that up. Just one sec. Oh, now my cursor is kind of going rogue here. I had it all set up so nicely. Oh, must be Monday. I was off visiting my grandson in Bend, Oregon this weekend, and we were talking fine motor skills, and I guess mine have gone walkabout. But if you go to schwab.com/coaching, you can see not only when all the webcasts are happening day to day, and we've got webcasts happening basically from the time the market opens until an hour after it closes. But we also host these in-person events. And the next one is this Friday in New York City. It runs from 9 until 4. We provide breakfast, we provide lunch, and we provide a great reception with, drinks and wonderful hors d'oeuvres afterwards. And it kind of starts from what's going on globally with the markets, what's going on within our country, how are tariffs impacting things. We're looking at sectors and how they've reacted to things happening in the markets. And then we get right down to discussing individual companies and even looking at some potential example trades for example purposes. So we go from here to here within the course of one day. And Ben is leading the charge on that, and I will be there as well. Then we have a 2-day event in Santa Clara, which is booked, so you can't even register for that one anymore. And then back to New York in August. And I mean, you can see our lineup right out to the end of the year. We close in Miami the week before Christmas, Friday, December 19th. Okay. And then we'll be visiting Houston as well. Anaheim again, before Thanksgiving. So, and these are free for you to attend. You have to get yourself there. We'll even pay for your parking. Okay. So if you haven't ever attended one of these events, you may want to check it out. Okay. So let me just let me get this back. Sorry, I just messed some stuff up along the way here. Okay, there we go. Just want to make sure I can see my chat. Okay. So when we look at what's happened with the S&P 500, and I no longer spend a lot of time on looking at the individual market overview, because Kevin Horner does a great job several days a week to kick off the trading day as the market opens. And so but we can see we had a great fall here from the end of February through the beginning of April, and we've had quite the comeback. We're not back to the February 19th highs, but we've come a long way since our April 7th lows. And that's our S&P 500. When we look at, we're now actually in the green for the year, up a modest 1%. We're up double that on the NASDAQ. We're up 2%. And a similar looking chart, right? And again, we're not quite up to those February 19th highs, but we're certainly heading in the right direction. When we look at the Dow, kind of more of the same, although it's got a much longer way to go to get back up to the all-time highs that it hit at the end of January. So it's been a little slower on the uptake. And, when I look at this chart on the Dow, I see this inverted head and shoulders, and it hasn't quite broken out across that shoulder line yet, right? It's still got a ways to go. So this seems to be, maybe not rebounding with quite the same oomph that the S&P and the NASDAQ have. And, UNH, United Health, you only have 30 companies as part of this index. And this has had a tremendous fall. So it's been kind of anchoring, and it's not the only culprit, but it's really been weighing down the Dow. And the Dow is different from the NASDAQ and the S&P in that it's not based on market cap. It's based on the price of the stock. So that's something we want to consider as well. And I haven't looked at that actually, but if we take a look at last price and we organize from top to bottom at 300, UNH is one of the more expensive stocks, isn't it? Yeah. So, this has not been a trivial hit to this index for this year. Okay. And how about we look at the VIX? Back at 21, so it's kind of been in this range here between, 17 and 22 for a couple of months now, from May, for about a month and a half. But, it's come down a long way from, when it hit 60 back on April 7th. Okay. Okay. So let's come and look at some stocks that have been just kind of cruising along. And this has kind of followed the S&P and the NASDAQ, hasn't it? In that, it had this fall very similar to the other indexes and then has come up. Where it differs from those two indexes is that it is now hitting a 9-month high. In fact, if we come and look at a 5-year weekly chart, this is a 5-year high for Cisco. And what sector is it part of? The technology sector. And, how's the tech sector been doing? Well, if we come and we look at our public watch list and look at the sector indices, technology, when we look at who's been strong the last 4 weeks, technology in the number 2 spot, and it's in first place over the last 3 months. So, it's a strong stock in what has become, once again, a pretty strong sector. And so could we look at this, and this is, let's come back to a shorter time frame. Could we look at this at cup and handle type pattern where it's breaking out and look at a continued bullish trend and maybe do something like a long call vertical? And it hit 67.36 today. So could we do something like 65 where it's already in the money and 67.50? Okay. And I'm just trying to bring my chat. Okay. It's not wanting to move. So let's come to the trade tab. And I'm going to get rid of this. And if we look out to July, so that's 25 days out, what we can see here is at the 65 strike, we have 22,000 contracts. And then for open interest, we have nothing on the books for the 66 and the 67. Why is that? Well, it's because we just closed out the monthlies for June, and these strikes have just become available. Okay, so you can see we had 243 contracts already traded today at the 67 strike. But when we have this type of, huge numbers and then zeros, it's usually because new strikes have been added. And so this isn't to say that we would refuse to trade these. We have a 5-cent bid-ask spread, which is certainly in that realm of acceptability. But if we want to run where there's lots of liquidity, if it's feasible, we might want to stay where we have these, 20,000 plus number of contracts. So it's obviously very heavily traded. So if we come here and we say, okay, we would like to buy a vertical, it's going to default to the closest strike above, but could we make that the 67.50? Well, we can. And then remember, we had decided that we were going to do a 25% return goal instead of the 50% we'd been using over the last couple of years, because there had been, so much uncertainty in the markets. And so if we said, okay, $1.56 times 1.25, our goal then would be to exit this when it gets to $1.95. Now we can risk up to $500. So if we say, okay, we're going to do 3 of these, that would be risking about $468. And if you want to get specific, you can bring this up. Yep, we're risking $468. And if we want to put in our target exit, we're going to make this first trigger sequence, right click, create an opposite order, and we're going to put in our $1.95. Good till canceled, confirm and send. We're going to put that in our long call vertical bucket and fire in the hole. Now let's look at Oklo. Now, if you're not familiar with this company, it's a utility. So it's advanced fission power plants, sounds like nuclear, to create clean, reliable, affordable energy. commercializes nuclear fuel recycling. Now, when I looked at this at the beginning of the day, it was sitting right on this 55 line. And, if I was playing I Spy with my little eye, I'd say, I see a cup and handle where it broke out and it came back to retest. But now, not so much. So, my comment on this one, as it's sitting on this perch, was maybe we wait. Now I'd say we definitely wait to see if it's going to come back and if this 55, 60-ish range is going to hold. And so on that one, we wait. Okay. So let's go on to the next one. And, Josh in the chat is saying, it is nuclear and it's 5 years away from delivering a product. So, okay. So let's look at Dash. So Dash is, not that far away from delivering a product. If you give them a ring a ding, they'll deliver, your heart's desire relatively quickly. And we saw this kind of consolidation pattern here. Some might have called it, if we had drawn our line down here, we had a bit of an inverted head and shoulders pattern. It's broken out. Then it came up above. Do you guys see that? That pattern there. Then it broke out. Sorry, I've been posting stuff on X. All right, let me just go to my freeform. So here's our inverted head and shoulders pattern. It went from, 155 to 202. So that's a range of 45. And so a technician might say, I could see it maybe, we want to see it go above here, and it came above, and then it seems to have been hanging out with this as a support level. But a technician might say, I'm going to put my target here around 247, $45 above that 202. So might that have the potential to continue to move to the upside? Now, today we've got this, it did have a big move, hit a new, I don't know if that's an all-time high, we could look, but it's certainly a new year-to-date high. And this is a stock. Remember, the S&P and the NASDAQ are up like 1 to 3% between them, and Dash is up 33% year to date. Like, look at this before, kind of all hell broke loose at middle of February until April 7th, which is when the NASDAQ and the S&P hit their bottom. So did Dash, and then has been rallying since. And so, so not quite a 5-year high. We did have a high here, back in 2021, but it's certainly a high for the last 3 years. So, could we look at this and say, hey, could we do a long call vertical at maybe 225, 230? With the assumption that this might continue to move to the upside. And, we could come and we could look at news on Dash. So JMP Securities raises price target to 235. B of A raises price target to 245. Stifel announces a price target, starts coverage, announces a price target of 198. Interesting how they're all over the map. But these two raised price targets. This guy just started covering them. Raymond James adjusted price target to 260 from 215. So, who's right? We don't know. But the sentiment by the analysts appears to be bullish from that quick overview. So if we come to our trade tab, could we come out here? And again, you see this. Here's our 220. Now the 225 just became available today. So are we okay trading that? Well, we have a 30-cent bid-ask spread. The stock's already traded 2.5 million shares, And the 230 strike that we were looking at has 1700, 544 traded today, and that has a 25-cent bid-ask spread. This one also has about a 25 bid-ask spread. So if we said, okay, if we went to this 225 and it will default to the 227.50, and you know what? We could say, hey, it has even less distance to go if we choose the 227.50, and the 227.50, that's a new strike available today, but already has 170 contracts. So our target, if we did that, would be 143 times 1.25, be 178. And, we have less than $1 to go, where if we make it 245, 230, 225. Here's our 230. It has to go further because it's at 226.64. So it's got to move up another $3.40 ish in that range, and then stay above for us to get our max gain. Now we're only going for 25%, and our break even on this is about $1 and a bit higher. If we look at the shorter strike, which wasn't my original intention, let's look at our break even on that. It's actually basically, 6 cents below where it's currently trading. And so maybe we go with the shorter strikes here, to make it easier on the stock. It doesn't have to go up as much. Now we're going to pay more in commissions or in transaction fees because we're going to do more contracts. We're risking $1 here. And so, how many of these could we do? We could do 5. And then when do we want to get out? If it's $1.10 times 1.25, that's $1.37. We want to exit when it reaches $1.37, which would be a 25% gain. Now it's at $1.13. Dang, like the price is all over. 115 times 1.25, 144. Okay, $1.50. That's my final offer. We're going to just get this in. Now we can always adjust our target when we get out. Man, things are moving quickly. Margin. We're going to put this in our long call vertical group. Okay, and we'll give that a couple of minutes to percolate and to fill. Now it's at $1.35. Like, that's crazy. It was at $1.10 a few minutes ago. So, if we make this if we end up having to pay $1.30 for it, and let's give it a couple of minutes to percolate, then we'll go in and adjust our exit. Okay. So we're just going to leave that alone for a couple of minutes. Okay. So let's go and look at Amazon. So Amazon, and we've seen a lot of these types of patterns of late, where it came down here, and let me guess the date, April 7th. My goodness, I'm just psychic, aren't I? A lot of things hit their bottom on April 7th and then started to rally, right? Yeah. So we had this double bottom pattern on Amazon, as we saw on many stocks, and then it broke out, came back to retest, and it looks like it's retesting again. Now, some might say, hey, don't you teach getting started with technical analysis? And I do. And the idea when something comes back to retest, if it's this type of hammer pattern, we wait for confirmation to see if we have a close the next day above. So if we were to place a trade today, that would be considered a more aggressive entry because we haven't waited for that confirmation. Okay. So, but if we said, well, we see it's come up into this neighborhood once, twice, 3 times, 4 times, 5 times, and we're okay with that. And we'd look at something at maybe, could we do a short put vertical, which is a little more conservative. So as long as it stays above maybe 205, might that work? Yeah. Well, let's go see. 205, where we're selling the 205 and we're buying the 200 with the goal of it just staying above that 205. And sometimes these work out beautifully and you could throw your shoulder out for patting yourself on the back. And then sometimes they don't work out at all. And you're going like, why didn't I wait for confirmation? And so you might say, I'm going to wait. I wouldn't place this trade today. And that's a totally legit approach to take. And again, like even here on Amazon, we've got zeros here on the 202.50, which means that these just became available today. And we have, a 10-cent bid-ask spread here, same as we do on the 205 with the 10,000 contracts. And so what this is telling us is that the market maker is expecting these to be heavily traded. Well, now they're 5-cent bid-ask spread. So could we sell the 205, 202.50 or the 205, 200? So at the 202.50, we get 80 cents. So, okay, it's now saying, well, let's go with 80 divided by, we're risking 250 minus 80. So divided by $1.70. 47% return on risk. For a trade we'd be in for 25 days. So that is certainly considered acceptable by our example trading plan standards. We'd get $1.42 if we double the risk, not $1.64. Kind of interesting, isn't it? But $1.45 divided by 355. That's a 40% return on risk. So it's a little less, but your second strike is further away. So the odds of it going through both strikes are lower. And so that's something to consider as well. But your short strike is the same. So your goal is actually the same here. You want it to stay above 205. And so if we look at this and say, okay, well, how many contracts could we do here? The most we can do is one because we're risking $355. And the most we can make is $1.45 per share, or $145 per contract. So if we say, okay, we're going to do one contract, then we're going to change this to first trigger sequence. And our goal is to get out when we've got 80% of our max gain. So we might say, okay, when this is worth 29 cents, I want to buy it back. Now, if on Wednesday when we meet for trading price patterns, which I treat as a companion to this class, could we, if we've got 50% of our max gain, could we say, hey, we were willing to be in this until July 18th, and we just got 50% of our max gain in 2 trading days. I think that's enough. Could we change our minds and exit? Of course we can. And might we do that? Absolutely. We'd have a little conversation about it. I'd probably do a vote and we'd decide as a team. So we're going to put that in our short put vertical group. Okay. Just let me look at the chat. 5 times the lady. Yes, I say that a lot. Did I say? I don't remember if I said that today. Okay, so I haven't seen this other thing fill. Oh, look at this. It's now up to $1.48, which was our original target. Dang it. Okay, so with Amazon, July 18th. Oh, this is our Amazon, sorry, Dash. Dollar, it's now at $1.35. So we're just going to cancel Dash. We're just going to cancel that whole thing for Dash. And we'll go back and look at putting in just a new, oh, now it's at 128 or 130. Did I cancel the Cisco by mistake? Waiting for trigger. So here, it now it's at 132. So let's cancel and replace. $130. Long call vertical. And then when that fills, I'll show you how we could go in and update our exit if and when it fills. So let's come over to the bearish side of the street and let's look at DHI. So with DHI, this is a 6-month chart. When we look at this, even from a 9-month, this is a stock, it's down 9% year to date. If you're not familiar with this company, it's part of the consumer discretionary sector. It's a home building company. I don't know that I consider buying a home discretionary, but hey, I didn't get to pick what category things go into, but it's in the home building category. And, interest rates have not come down. Mortgage rates have not come down appreciably, some might argue. And so this has been on the struggle bus. But today it's rebounding. And I was thinking maybe we could do a short call vertical where we say, hey, I think it's going to continue to stay below 130. But what's it doing today? It's rising. And so even though we're looking at this and saying, hey, I see a potential to do a short call vertical here, what do we want to do? We want to wait to see if it comes up and hits its head on this 129-ish level that it's hit, once, came up again here and here and here. Is it going to come up and hit and then roll over? And so sometimes the best trade is no trade at all. It's to be patient and then see if it comes up and does that within a time frame that we could place a trade like this and be out prior to earnings. Because that's another thing we have to contend with also. And this has earnings coming up. And it's July 22nd. So after the July monthly expiration date. So we're going to wait on that. How about KBH, which is another company in that arena? Well, it too is on the struggle bus, but it's got earnings on the 23rd. So, we're going to just wait on this one as well. And then the last one in my little trio of bearish or bearish to neutral, we've seen Mondelez kind of had a great fall. It too hit a bottom. What date? This one was different, February 5th. And then it kind of rallied, but it keeps hitting its head around this 68 mark. And it's hitting its head here again today. And when is earnings? Well, it's not till August. So could we come out and sell something around the 70 maybe? And so if we look at this, these just became available. We're seeing that all over the place. 2 and 3 contracts, 10-cent bid-ask spread. Now this is on a $1.20 option. So we don't want it to be much more than that. A 10-cent spread on a 75-cent to 85-cent option is a little rich. And if we come all the way out here to the 70 strike, and wanted to do, say, the 70 and the 72.50, we just don't have enough premium. I mean, we can click on it and say, could we sell a vertical here at 70 and 72.50 where we have volume, but we're just not going to get enough premium. 37 cents, you know, when we divide that by the 213 we're risking, that's only a 17% potential return. And so you have two choices. Just you don't take the trade at all, or you say, well, I don't think it's closed above 68. Like here, the high was 67.80. Here, the high was, you know, it closed at, well, here it closed at 68.13. Here it closed at 68.31. So we'd want to be at least 69. And if we did the 69, and again, we don't have much volume here, we'd get 32 cents. Now, 32 cents is probably enough. 32 divided by 68, that's closer to 50%, 47%. But what rule are we breaking? We're breaking our position sizing. We don't have enough contracts here. And, you know, our volatility is pretty low on this one also. So even though with the 69 and 70, the juice would be worth the squeeze, the volume puts us at risk for making it difficult to get out of the trade. And we want to be able to get in and out easily. So sometimes you just want to err on the side of caution. And for that reason, it's not like, oh, I'm afraid to pull the trigger. We have no fear in pulling the trigger when it makes sense. But this modest, you know, implied volatility coupled with very low volume on these is, you know, making us understandably hesitant. You know, and so might we miss a trade that would have turned out to be profitable? Absolutely, we might. Now, it looks like we did get filled on our sticky dash order. And so we got in at 130. So in at 130, where would we want our exit to be if we wanted to make 25%? It would be 162.50. So for dash, we have an exit at 150. Dang, like we came from 110 when we started talking about that. So we are going to cancel and replace this, and we're going to make this 163. That's our long call vertical. So that's that one. And then I think I may have mistakenly canceled an order. Now, what's one quick way to see that? There's two. One is to come down to our short put verticals and say, you know, we did exits. We have exits on all of these positions. Okay. So it wasn't our short put vertical. What about our long call verticals? Well, we don't have an exit on Cisco. So it looks like I canceled that by mistake, and I did. So we're going to come here to this, and we're going to say, create a duplicate order. To say, yeah, we wanted to get out when it hit 195. We still want to do that. So we're going to confirm and put that in our long call vertical. And it's a limit order, so it won't trigger until it gets down there. And so, you know, part of that, you know, dang it all, we are human beings. So now we have exits on all of these. Now, Boeing, remember, we wanted to get out if something was down 25%. I know we talked about this last week. It's down 81% on this long call vertical, but we're up a bit today. And we also have a short put vertical. And if it says in the money, it means it expires this week. And what else does it mean? It means that the risk of assignment might be higher. Okay. Because this is in the money, but it hasn't gone through both strikes. So we're going to look at Boeing. And so what we're seeing with Boeing is that it came down, found this bottom, and then we had this inside day on Friday, right? Saying, hey, it may have found its bottom and be coming back up. So we're going to give it another couple of days to percolate. We'll be meeting together again on Wednesday, and we'll look at this Wednesday as we're already down 81% on that. So guys, that really, about chews up our time for today. If you have not subscribed to the Trader Talks channel, if you're new here, you're going to want to do that. So you're going to want to subscribe by hitting that bottom in the bottom right corner. If you could also hit the like button. By hitting like, what this does is it moves it up in the algorithm so more people can find this content. And so if you could do me a favor and hit like, you could be doing a random favor for a stranger whom you may never meet. And then if you've never attended a live event, go through that list I showed you, go to schwab.com/coaching and check it out. You can also come here. And if you want to go to something, as soon as it opens, sign up so that you don't end up shut out, because these tend to fill very quickly. But if you are also newer and you're saying like, hey, what is coming up the rest of the day today? Well, here today is the 23rd. We're at Trading a Smaller Account. Up next, Trading with Technical Indicators with the fabulous James Boyd. You won't want to miss that. Then we've got Trading Covered Calls with Mr. Ben Watson. And I want to point out Connie's class, Trading ETFs, because this is a great class, and it's one of 2 classes that is not available in the archive. So if you want to attend this or watch this, you have to be there live. It's at 4 p.m. Eastern every Monday. The other class that is not archived and is a huge hit is Trader Talks on Fridays, where Kevin and James Boyd talk ETFs together. And so those 2 are not archived. So you'll want to check those 2 out as well. I don't believe there was a survey today. Let me just scroll up and have a look. It looks like you're off the hook for that today. But one of the comments in surveys past, and I do read each and every comment when they come in, is that you really appreciate having a review at the end. So what did we do today? We placed 3 new trades. We did a long call vertical on Cisco. We did a short put vertical on Amazon. And we did a long call vertical on DoorDash, ticker symbol DASH. In addition, we looked at KB Homes. We looked at, which is KBH. We looked at DHI, another home building stock. And then we looked at Oklo, OKLO, and decided to wait on that one as well. So thank you for joining me, everyone. Stay tuned for James Boyd, who will be coming at the top of the hour. Thank you so much for joining me. Thanks to Ben Watson for his assistance in the chat, and to the guys behind the scenes for helping bring this webcast to life. Take care, everyone. Have an awesome day. Bye for now.